Welcome everyone to today's Inspire Perspectives webinar. In this part of the webinar series, we'll be taking a deep dive into the employee benefit plan governance and audit matters. Before we jump into the presentation, though, I would just like to introduce Alaris and thank you to them for joining today as a co-presenter, and specifically John Jeffrey. When we were kind of putting together the initial planning for this webinar, we thought it would add value to get some insight from a third-party administrator on these topics. And, we have a really good working relationship with Alaris and really value what they bring to the table as a TPA. So, John, I know you put a lot of time into this along with others at Alaris. So thank you very much for doing that and joining us today. With that, we will go into introductions. So I'll introduce myself first, and then we'll throw it over to John and get into the presentation. So I'm Adam Campbell, and I'm an audit senior manager with Eide Bailey. I've been with Eide Bailey for a little over 10 years now, and I worked in the employee benefit plan practice that entire time. Each year, I do about 30 to 35 benefit plan audits each year, and then I also help to facilitate, train, and supervise staff here that perform over 300 benefit plan audits each year. I'm also heavily involved in our SOC 1 practice, and we do a lot of SOC 1s over employee benefit plan administrators. And to kind of go hand in hand with that, we also have an internal SOC 1 review team for the employee benefit plan practice here at Eide Bailey, and I serve on that team as well. Kind of just a quick introduction of Eide Bailey's benefit plan practice as a whole. We currently have about 30 partners and 170 staff that are in our employee benefit plan practice. And we perform about 1,200 employee benefit plan audits each year. So we do have 3 learning objectives today. John will be talking about fiduciary duties, risk, and how to mitigate those risks. And then I'm going to jump into kind of audit specific items. So we'll be talking about common adverse audit findings that we see on our audits, and then how to mitigate risk with that. And then finally, there is a new auditing standard coming down the pipeline for next year. And so we want to make you all aware of that, that change, and then kind of what to expect with that. Okay, so I'm going to fast forward here as we're waiting for John. Okay, so we're not switching gears. We're gonna start here with the audit side of things. So in a little bit here, when John rejoins us, he is going to talk about fiduciary duties within employee benefit plans. So that'll be a good kind of introduction into what your duties are as a fiduciary and how to minimize risk. These specific slides are audit specific items. And so the AICPA calls plan audits an accountability mechanism. And it's done by a independent third party. And it's really kind of checking that the plan is following their plan documents, and then also that the fiduciaries are following their responsibilities as well. So part of the DOL fiduciary responsibilities, it does say on there that plans must follow the terms of their plan document to the extent that they are consistent with ERISA. And so a lot of these findings that we're going to talk about here do kind of revolve around the fiduciary duty and then following the plan document. So these are items that we consistently kind of see pop up year after year as common findings. Okay, so we are going to specifically talk about 5 specific findings or adverse audit findings during this session. So the first one is timely remittance of contributions. Then we'll jump into definition of compensation. We'll talk a little bit about employee eligibility. We'll talk about vesting and forfeitures and kind of the risks that come along with calculating those. And then finally, having fiduciary oversight and kind of neglecting that and not doing responsibilities when it comes to that. Okay, so the first slide here that we have is timely remittance of contributions. So, this it's been a hot topic for many years now, and it's not going away. So, the DOL says that we have to remit contributions as soon as administratively possible. So each company has to decide what is as soon as administratively possible for them. Once they come up with that, consistency is key. And so we know what our number is. We know what our as soon as administratively possible number is. After that, we need to be consistent with that number. There's always going to be certain instances that come up that kind of knock you outside of that normal range. And, when that occurs, we just want to make sure that we have documentation on it, kind of supporting why it fell outside of that normal range. If there is a correction that is needed for late contributions, you can work with your third-party administrator and also your auditor for guidance. So risk mitigation for timely remittances of contributions. Like we said, determine what is as soon as administratively possible for you. So know what that number is. After you've kind of come up with your controls and you know what that number is, be consistent with that pay period to pay period. Third one here that we have is have a backup plan in place. So, if someone goes out on PTO, is sick, there needs to be a backup plan in place to make sure that the contributions are still remitted timely. And then finally, the last one there is having documentation. So for anything that falls outside of that normal range, making sure that we have appropriate documentation on why, and then what you guys did to correct it. Okay, next one we have here is compensation. So this is probably, or maybe the single most common finding that we come across in our audits. So it's the main thing here is compensation is unique for each plan. So it's really important to know what your plan documents say regarding compensation, and really digging down into specifically what it says in the plan documents. It's worth noting that this is something that is going to kind of consistently change. So there's, companies are always coming up with new ways to pay employees and implement new pay codes. There's always new incentives. So it's really making sure that as things change for you, or you add or take away certain types of compensation, that you're adjusting and amending the plan document as necessary to make sure that those two are kind of always in agreement with each other. A good example that we're kind of running into this year is with COVID pay. Last year, a lot of companies were giving their employees COVID pay during the shutdown. And we're seeing that companies treated that in many different ways. And so, we may have a plan that the plan document says, wages are W-2 or compensation is W-2 wages, no exclusions. Well, then they're excluding COVID pay from contributions. So that is, technically not correct. But that's just kind of one example. So like I said, things are always changing. So it's a matter of knowing what your plan document says, knowing what you're actually doing and what your intentions are, and making sure that all of those jive together. So risk mitigation on this one, like I said, know what your plan documents say. Does it match your intentions? Be detailed. So, kind of in that adoption agreement, specifically what your intentions are, make sure that it reads the same way as what your intentions are. And then constantly have a process and controls in place to update as needed. Okay. Employee eligibility is our third one here. This is definitely common. I do feel like there are pretty good controls in place at most companies to, kind of combat against this. But what we're referring to here is when are employees eligible to participate in the plan? Similar to your definition of compensation that we just talked about, it's very important to know exactly how your plan document reads for employee eligibility, and then have controls in place to, make employees aware that there's a plan, and then that they're eligible to participate in that plan. John will talk about here in a little bit fiduciary duties, but one of those duties is to, make sure that employees have been made aware of the plan and that they can participate. And so you need to have some sort of process in place to document that this is occurring, and that employees do know that there's a plan and they have the option to participate in that plan. Let's see here, risk mitigation. A lot of these are going to piggyback off each other, but documentation is key. So, know what your process is for making employees aware of the plan and that they're eligible to participate, and document accordingly. Processes need to be in place and consistently applied. So, make sure that you know how your plan document reads, make sure that your TPA knows how your plan document reads, and there's controls in place to make sure that employees are becoming eligible at the correct time. Last thing we put on here is auto enrollment. We're seeing a lot of plans that are adopting this auto enrollment feature, and it does a couple different things, but one, it encourages people to participate in the plan. So the more people that we have saving for retirement, the better. And then also, it takes away a little bit of the administrative side of things, because people are automatically enrolled, and so a little bit less tracking on that side of things. Okay, we have forfeitures next. Investing. So this one's fairly straightforward, but we do continue to see this in our audits, and so we just want to make sure that you guys are aware that this is still happening, and kind of what is triggering some of these findings to occur. So, most companies have some sort of vesting schedule when it comes to years of service. I think where we see the most common errors in audits are those mid-year hires and terminations. And so a lot of times a plan document will say there's a requirement of 1,000 hours to be worked in a year to get credit for vesting. There should be some sort of controls in place to review those participants' hours and corresponding years of service, and making sure that the vesting percentage agrees to kind of how the plan document reads, and then the years of service for those specific employees. I think as far as this one goes, and kind of risk mitigation, the plan sponsor should have controls in place to do their reviews of vesting. But I think it's also very important to be in constant communication with your TPA, and making sure that they know exactly how the plan document reads. Are there any kind of unique situations that could occur with vesting, mid-year hires, mid-year terminations, anything like that? And once they're aware, they can look out for it too. So you have kind of multiple people looking after it, multiple people doing reviews, and it should cut down on any errors that could occur. Okay, so poor fiduciary oversight, and I'm not going to spend a ton of time on this slide, because John is going to go into a deep dive on this. But I think from our audit perspective, the main thing here is knowing what your responsibilities are, and then kind of documenting appropriately. So a couple things that I'll draw your attention to on this slide would be the first one there. So keeping meeting minutes. Any major plan decisions that you guys are having should be tracked through meeting minutes, and we will specifically request those during our audits. And then the second thing, obviously, to perform an audit, you need to look at backup documentation. And so ERISA does require plan records to be held for a minimum of 6 years, and we will be asking for plan records during our audits. And so making sure that you have a process in place for record retention, and making sure that you can kind of dig up the appropriate records when asked for. Like I said, John's going to cover this in detail, so I'm not going to spend too much time on this slide. Okay. Now we are going to switch gears a little bit more here, and there's a new audit standard coming down the pipeline. So if your plan files as a large plan for 5500 purposes, this new audit standard is going to affect you for 2021 plan year audits. For our personal clients here at Eide, we're doing our best to get the word out to them. But I think this is as good a stage as any to make sure that people are aware that there is a new audit standard coming. So what to expect with this change? So it's Statement on Auditing Standards, or SAS 136. It was originally going to be effective for 2020 calendar year end plans, but they pushed back implementation 1 year due to COVID. So now it's effective for 2021 calendar year end. So this is going to be a next year thing. Previously, we were doing limited scope audits where the auditor would rely on a signed certification from the trustee or custodian. And that would basically say the investments are complete and accurate. And then therefore us as auditors would issue a disclaimer of opinions on the financial statements. And kind of what was happening here was this disclaimer was causing confusion for the reader, as they didn't really fully understand what was being done. And it was hard to tell what was being done in these employee benefit plan audits, because we were saying, we disclaim this opinion. So this new audit standard is going to remove that disclaimer of opinion for limited scope audits. And now we'll actually be giving an opinion over the financial statements. And this will look kind of more similar to the other audit reports that you're used to seeing, where an unmodified opinion is given if everything is clean. Another change with the standard is, instead of being referred to as a limited scope audit, it will now be referred to as a ERISA section 103A3C audit. So kind of a mouthful there. One additional comment, I guess, that I'll say here is this specific presentation is concentrating more so on the limited scope audit side of things. This does affect full scope audits as well, but because we were historically in a full scope audit, you're giving an opinion already, and you're testing investments. There's less effect on the full scope side of things, and so that's kind of why we're concentrating more on the limited scope side of things. Okay, so these next two slides here will show the difference of opinions that is going to happen from this new audit standard. So this first one here, you can see that we were issuing a disclaimer of opinion disclaimer of opinion within the financial statements. So we were saying that we were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. The next slide will show what the new opinion will look like. And so here, like I mentioned, we actually will have an opinion over the financial statements. And so it will give, hey, here is our opinion that we are issuing over this financial statement. And then you can also see where it references the 103A3C information there. So this is probably the biggest change that you guys are going to see, is the change in opinion from a disclaimer going to an actual unmodified opinion.
Adam, just a question, so as a record keeper and trustee, when we certify assets, our obligation to provide certification, is that changing, or is that we still provide you with certification that these are the assets, they actually exist as of a certain balance sheet date, etc.?
Yes, exactly. We'll still get that certification from you guys. Yep. It'll strictly just be how we communicate that to the reader of the financial statements in the opinion that we give. Whereas previously we were disclaiming it, and now we're actually call attention to it and then say we're giving an unmodified opinion. So yes, we will still get that certification from you guys.
So essentially the audit procedure with regards to the platform, the custodian, the record keeper, that's essentially the same, provide you the same information, same certifications.
Yes. Yep. Okay. Yep. Okay, so these next two slides here are just some additional items that are going to come of this new standard here. The first one is engagement acceptance requirements. So we do, as an auditor, have a few additional engagement acceptance procedures that will take place. I don't foresee this being a major issue for you guys because it's really just going to affect our engagement letter language, where there'll be, you know, a few tweaks to that. So the engagement letters will look different in 2021, but other than that, you know, there's not going to be a huge change there. The audit risk assessment and response, once again, there's a couple additional things that we'll have to do from our audit risk assessment side of things. And so, you know, your kind of initial calls with the auditors may change a little bit, may have a few additional questions that you're not used to historically, but there shouldn't be kind of, you know, major changes to any audit procedures. We feel like here at Eide that we were doing sufficient audit work before, and the actual audit testing going forward isn't going to change. It's strictly just going to be, you know, the reporting that is going to look different, and then some of these engagement acceptance, and you'll see on the next slide here, engagement issuance documents as well. So here is what I was referring to earlier with the engagement issuance documents. But there are a few new kind of guidelines on reportable findings to those charged with governance. And so your management letters, if you think of like the AU 260 and 265 letters that we've sent historically, there may be some tweaks to that that you'll see going forward here. And then the rep letter, there will be some additional representations and some tweaks to the representation letter that you guys will have to review and sign for at the end of the engagement. The last two here are really kind of audit specific items, but there's a few tweaks, I guess, to the considerations relating to the Form 5500, and then the reporting on the ERISA required supplemental schedules. So final tab here, I believe, is main takeaways. So the main takeaways with this new auditing standard, it's going to be effective for 2021 engagements. So like I said, it was originally going to be 2020. And so like if you were to go look at the actual SAS, it would show effective date of 2020, but it's 2021 now due to COVID. It's been extended a year. Expect changes to the audit report for next year. We went over kind of the opinion specific changes. And then a few of the other kind of required documents that we have. So engagement letter, rep letter, and those management letters that you guys see, those will change in language as well. Whenever you previously heard limited scope audits, that will now be ERISA section 103A3C audits. And so they will no longer be referred to as limited scope audits. And then finally, there will be a greater emphasis on management responsibilities. And like I said earlier, these will be detailed out in the engagement letters, kind of covered during our initial questions with clients, and then communicated at the back end of the audit as well through those rep letters that you guys are responsible for signing at the end of the audit. And I believe that goes through my part of the discussion here. So John, I'm gonna go back up to the top here, and then I'll throw it over to you if I can get there.
Sounds good. Well, while Adam is frantically backing up his slides here, I'll just take this time to thank everybody for taking the time this afternoon. Apologize for that technical glitch. Although I'm an old guy, I've been at Alaris 20 years and 18 years before that in private practice. I actually understand technology. I'm just not sure what went bump. But in any event, we're here and we're going to proceed. Just a word about Alaris. We are a national bank. Our holding company is publicly traded, and we've been around for a long time, started back in the 30s, and we continue to be a national bank. We have our banking division, and then we have Alaris Retirement and Benefits, which is really the other half of our banking business. And I head the legal team for Alaris Retirement and Benefits. On the retirement side, we do all the usual retirement work, K plans, 403B plans, ESOPs, IRAs, you name it. We act as trustee, custodian, record keeper, third-party administrator. We provide investment advisory services, investment management services. So you can pick it all bundled, you can pick it a la carte. Pretty much anything on the retirement side we do. We do work in all 50 states, and currently we have about $1 billion, give or take, assets under management and administration. We also have the health and welfare side, which, if it's an acronym, we probably administer it. We do FSAs, HSAs, HRAs, COBRA administration. We provide payroll services, human capital management, pretty much in the benefits area. We handle everything under the sun there as well. So that's the Alaris commercial. And with that, we're going to get started here. Adam, I got control? In theory? There we go.
Yes, you do.
All right,
yep,
perfect.
good.
So here's what we're going to cover today with regards to being a fiduciary. So I've noticed in working with employers, sometimes it's the basic questions that need to be answered, and that's what we're going to try to cover today. So this is not a treatise on everything under the sun about fiduciary roles, but it's at a high level answering these three questions. Who is a fiduciary? If you are a fiduciary, what exactly is your job? And then what can you do, to control that risk? And we're going to have some suggestions on what you can do. So let's get started here with who is a fiduciary. This concept of a fiduciary comes about from the common law. It's based upon this idea that if someone gives you something, that you're supposed to take care of for them, whether it's money or property, you have an obligation to do that, the right way, to do the right thing. That's the law of trust. In 1974, Congress got together and passed ERISA, or the Employee Retirement Income Security Act, and that did a couple of things. One, it took the common law and it made it into a statute, and it identified, exactly who is a fiduciary, and then also began to outline what those obligations are. And it kind of, grew from there to what we deal with today. So the second bullet point that you're looking at here is describing the areas where you become a fiduciary. You can become a fiduciary if you have discretionary control over plan assets, or if you have discretionary control over plan administration. The operative word there is discretionary. And then the final area that makes you a fiduciary is if you're providing investment management or advice and you're doing that for a fee. And there's really two ways that you become a fiduciary, and that's what you're looking at here in the final bullet point. You either agree to be a fiduciary, so you raise your hand and you say, yes, I am a fiduciary, or you inadvertently become a fiduciary, and that's what's called a functional fiduciary. In most cases, everybody on this call is or has agreed to be a fiduciary. At least your entity has. Your company, your LLC, your partnership have all agreed at some point, and I'll show you in a minute how you've agreed to be a fiduciary. In most cases, folks aren't going to become a fiduciary by action. You'll notice in particular when you're working with outside vendors, they will go the extra mile to make sure that they clarify that they're just order takers, that they're not making discretionary decisions, although they may assist you with various activity or maybe advise you. The final control is always residing with the employer as the fiduciary, and that's really the issue here. Control, discretionary control determines that you're a fiduciary. This next slide is the ERISA defined fiduciaries, and there are 5 of those. The first one is what's called a named fiduciary. This is a provision of ERISA that says every retirement plan has to have someone who is identified within the plan and that entity or individual has the final authority when it comes to plan operation or administration. They also have the obligation to select and monitor other service plan providers. In almost all cases, that is going to be the employer. So whether you know it or not, someplace in your plan document, it's going to identify the entity, you know, ABC Company or ABC Incorporated or ABC Limited Partnership, whatever the entity is, that is going to be listed as the named fiduciary. The next role then is the plan administrator. And this too is identified in the plan document. And in almost all cases, that is also the employer. And that's the entity that has final discretion with regards to various aspects of plan administration. So determining whether or not a benefit is paid, or who the available beneficiaries are, or determining how a quadro should be interpreted. Those types of discretionary actions reside with the plan administrator. The reason it's called a 316 plan administrator is because these definitions appear in section 3 of ERISA. Then there's a long laundry list of definitions. When you get down to item number 3, sub 16, that identifies the plan administrator. And as I said, in almost all cases, that's going to be the employer. In some instances now, folks are farming that out. Alaris does provide that service to employers, but I'd say still in the majority of situations, the employer is the plan administrator. The next up, as far as roles, is the role of a trustee. Every pension plan has to have the assets segregated. So this means that if the employer fails, the plan assets aren't sucked into that bankruptcy. They are set aside in a separate trust arrangement. And every trust arrangement needs, of course, a trustee. Normally, that trustee is a directed trustee. That means that they follow the direction of the plan administrator or the plan sponsor with regards to how they handle plan assets. And their marching orders are basically to follow directions unless it's contrary to the plan itself or contrary to the plan document. One thing I want to point out here that sometimes smaller plans don't understand is that individuals can end up being the trustee. And this happens in situations where sometimes it's a sign here, sign here, sign here kind of deal. And an individual signs as trustee. They're not using a corporate trustee. Under those circumstances, the individual, unlike an entity, the individual has personal liability when they sign up to be a trustee. So if your entity is the named the named fiduciary, or your entity is the plan administrator, from a legal standpoint, liability stops with the corporate entity. But in the trustee setting, if you are, for example, the CFO and you sign on as trustee, you, Mr. or Ms. CFO, you are now personally responsible for that plan. So a lot of larger plans, if they have individual trustees, once they realize that, they will then hire a corporate trustee. Cost is usually fairly minimal, maybe an extra $500 or $1,000. And you have a directed trustee in place. The next two categories are with regards to handling the plan assets. And here's the difference between an investment manager and an investment advisor. The investment manager has total discretion over determining what the fund lineup is. And they will inform you if they're making a change, but they have the final say. That is probably the best way to unload responsibility to the fund lineup if you're the employer, to give it to an investment manager. But a number of plans do use the outside investment personnel in advisory capacity, and that's what's known as a 321 advisor. In that situation, if I'm the advisor, I'm going to provide you with information and suggestions with regards to the plan lineup. but you, Mr. Employer, as the named fiduciary, you're going to have final authority with regards to whether you want to follow that lineup or not. And in most cases, if the advisor is telling you to have a certain lineup, you're going to follow that advice, but you're not required to. In theory, in the 321 setting, in the 338 setting, you have no control. The investment manager just determines the lineup. And you'll notice here that in both cases, the advisor could work with individual participants, but oftentimes they're limiting the engagement just to work with the employer and the plan at a global level, and not necessarily with individual participants. So those are the designated roles that ERISA calls out. Here is the related obligations that go with being a fiduciary. The first 4 bullet points that you're looking at here, these are the do's. And then the final bullet point is the don't. So the first requirement is you always have to be loyal. Kind of makes sense, but loyalty means that you're watching out for the participants first and the company's interests second. So for example, let's say that you have a business relationship, a banking relationship with Alerus already, and that every other week our banking personnel is taking you out to lunch and trying to convince you that Alerus Retirement and Benefits is the best thing since sliced bread, and that you should be moving the business, your retirement business over because we already have the banking business. And let's say, to add to the facts, you have a line of credit. It might be a little bit tenuous. You're thinking that if I move the retirement business, that's going to cement the relationship. That's an example of, taking an action that would not be loyal. I mean, it's taking action with plan assets that are really, thinking more about the company than you are thinking about what's best for the plan participants. Now, that doesn't mean you can't, consolidate business. We have clients do that all the time. But what I'm suggesting is, if you're going to hire us or anybody else, still use the same due diligence to make sure that, what you're getting is a good product for your participants, and you're not just doing it, based upon a relationship outside of analyzing what's good for those participants in your plan. Next bullet point is also a due or a requirement. And that is, if you're a fiduciary, you always have to act prudently. And what does that mean? It means you're going to act wisely under the circumstances. And the sub bullet points I have here is really outlining, and maybe Adam address this, the process. ERISA is really about process when it comes to making sure you're prudent. And that process is basically this. You have to show that you gathered the facts, whatever was available at the time. So you're not required to have a crystal ball. You're just required to do due diligence and see and acquire the information that is here and now. That's the good word about ERISA, is that it's not a hindsight kind of statute. They're not going to second guess you. If you made a decision based upon the facts at the time and you followed this process, even if the decision farther down the road turns out not to be great, you're not the guarantor of the outcome. You are just responsible to have a good process to make that decision. So gather the facts, analyze the facts, and if you need outside help, whether it's a CPA, a lawyer, outside investment advice, you bring those experts in. Then you need to make the decision. And then if the decision is to affirmatively act, obviously you have to follow through on that. And if the decision is not to act, also document that. So as Adam pointed out, taking good notes is always important to support decisions that you're making on behalf of the plan. Third bullet point, you're required to diversify assets. This is a carryover from the old days when employers, had total control over plan assets. Now it's pretty easy to meet this criteria. Just about every plan has 18 or more funds that are varied between stocks and bonds and large cap, small cap, international, etc. This box is pretty easy to check. Next up, always required to follow the plan, the tax code, and ERISA. And if you think about it, this is a pretty big burden, right? Most plan documents now, if you're using our standard adoption agreement and basic plan document, you got probably 160 plus pages of fine print that controls how that plan works. And so that's why you need good outside folks that can, help you through understanding the plan document, the tax code, and ERISA. So the first four bullet points, as I said, are the to-dos or the requirements. The last bullet point is the don't. You can't have a prohibited transaction. And the way ERISA is put together is Congress wiped the slate clean. They said no fiduciary can deal with the plan unless you have an exemption. So all plan transactions are prohibited. And then between ERISA and the Department of Labor, they come up with these things called prohibited transaction exemptions. And so anytime that you are dealing with plan assets, unless you have an exemption, you're not permitted to do that. And it doesn't matter if you benefit your participants. So let's say, for example, I have a construction company, and I have this bright idea that I'm going to create a fund within my retirement plan. It's optional. Participants can use it or not use it, but the fund is going to be used to provide these mortgages to people that want to build new houses. And guess what? I'm the construction company that's going to build the new houses, right? And let's say that all just goes swimmingly. Everybody puts their money in. Everybody gets paid, they get a market rate or better rate of interest. All the participants are happy, but in the event of a DOL audit, that is still a prohibited transaction because I'm using plan assets for my benefit as an employer. And it doesn't matter that it all turned out fine for the participants. I still have a prohibited transaction with the related penalties. In a minute, I'll show you what those are. Okay, so here are some of the areas where we see problems on occasion. And most of these are related to the failure to use prudence under the circumstances. So one is with regards to the investment lineup itself. Sometimes, especially in smaller plans, we'll see folks that want to use some type of specialty funds. So currently the flavor of the day is investing in cyber currency, using Bitcoin or something. Everybody wants a piece of that. They're all excited about it. You put that in the lineup, and the risk to you as the employer is that essentially you're giving the participants enough rope to hang themselves, right? It's very volatile, and you can't assume that average Joe participant's going to understand how these things work. And so you potentially become responsible when you put, something in the lineup that is just kind of a fad. So you want a boring 401k. That as an employer, that's what you should have. A boring lineup, solid, good performance, but none of these specialty funds, whether it's precious metals at one point or now cyber currencies, stay away from that. Next one. Whoops, what did I do here? Next one, I think, just got to pay attention to the funds as far as performance. That is both fiduciary duty, and if your own money's in the plan, that's important as well. A third bullet point here with regards to life insurance. Life insurance can be included in a plan. It's kind of a legacy issue. Don't see new plans or new policies being added. But here's the problem for the employer. When your plan has life insurance, it's an investment, and you, Mr. Employer, are responsible for monitoring that investment. So what does that mean in the life insurance context? Well, if that insurance company maybe, originally was rated, A+, but now, is on the ropes and has the potential to maybe fail, you have an obligation to keep the participant apprised of that so that perhaps no future premiums go in, or if the participant has the option of taking the cash value and running, they know that. So bottom line is, if you have life insurance in the plan, you need to monitor that insurance company's financial ability to pay claims as time goes on. Next bullet point is putting in alternative assets. We see this sometimes in smaller plans where folks want to have a limited partnership or limited liability company or limited liability partnership. You know, one of those, when you see a bunch of L's in the name, that is not a good sign, right? It's usually not publicly traded. It's going to have valuation issues because there's no easy way to determine what the value of that asset is, but you as a fiduciary have an obligation to value the assets. They may have liquidity issues. It may generate unrelated business taxable income. They just have a lot of problems. In most cases, if folks ask us, we're going to discourage you from putting in alternative assets in the plan. And then the final bullet point under investment lineup, probably, you know, once every month I have a call from employers and they have this great idea that, you know, the company is expanding and they want to put in company stock. Now, outside of an ESOP, there's special rules for an ESOP, but outside of an ESOP, for a K plan to hold company stock, even if it's publicly traded, you know, that has a potential or creates a potential trap farther down the road. And the way the problem arises is when management realizes that the company's in trouble. For example, you know, Alaris is publicly traded. If management had some inside information, they can't release it just to the participants. They have to release it to the public at large. But that's where the conflict arises, is because the participants then claim that they should have been told sooner with regards to the issues of company stock, so they could have diversified or, you know, sold off. And invariably, you know, management then is stuck between a rock and a hard place. So usually employer stock, not a good idea, even if it's publicly traded. If it's not publicly traded, then you have all the same issues as alternative assets with regards to valuation, et cetera. So in most cases, you know, don't put the company stock in the plan if you can avoid it. Next big area, and this is one involving a lot of litigation recently, is failure to monitor vendors. And here, the issue really is the failure to understand you know, what the fees are being charged by the vendors, if they're not all, you know, clear, or not understanding, you know, revenue sharing. And also the new hot topic is with regards to security. You know, does that vendor have adequate security? And here too, you know, you have to understand who your vendor is, because you may have a trading platform that is through some large vendor like Fidelity. But if you have a mom and pop TPA, that TPA is handling sensitive information. You need to understand, you know, what that TPA's security provisions are and how they are protecting data. You know, so it all wraps together. And it's not just assuming that because you trade on Fidelity or trade through Schwab or even through Alaris, that they're protecting all aspects of the plan. What they're going to protect is the assets that are in their custody, but other information, you know, you have to understand the role of these other vendors and how they play into that. So need to monitor those vendors. Adam touched on operational failures, and here the fiduciary issue when it comes to an operational failure is not so much the failure, but the failure to remedy. So, you know, I become cognizant of the problem, but I don't do anything to fix it. That's where you have really the fiduciary risk. Or I have a problem, I fix it, but I don't fix the underlying structure that permitted the problem, and then I have it repeat again and again. Now I have a fiduciary failure. And then the last one I think is just obvious, you know, stay away from using plan assets somehow you know, that are indirectly or directly benefiting you as the employer. So here's the parties that you have to answer to. And primarily they are two. You have the Department of Labor, you have individual participants. Okay, Department of Labor has the ability to audit both plans and vendors. They, like a lot of regulatory agencies, they got a lot of clout. They can come in and enforce administrative penalties. Those are usually dollar amounts per day. Like, for example, if I remember right, failure to provide a blackout notice comes at $143 per day for every day in the violation. So, you know, those are concerns. If you have some type of fiduciary breach, they can come in and require you to make the participants whole. And then in addition, they have, and actually they're required to collect an extra 20% above and beyond the breach amount. So that's your incentive to play by the rules, because if you get caught, it's not just putting the money back, but it's putting the money back plus an additional 20%. And then to layer on that, if you have a prohibited transaction, under those circumstances, you might have a fiduciary breach with the problems above, but even if you don't, you know, even if the participants were not harmed, like in my construction company example, you still have the obligation to pay 5% of the amount involved in the prohibited transaction for each year that the transaction exists. So in my construction example, let's say that that went on for 5 years, and you know the outstanding amount was $1 million a year in overall loans. Well, that's a $50,000 penalty per year, that every year that I had that total value of $1 million outstanding. And then on top of that, the IRS has a code provision that also prevents prohibited transaction. It basically dovetails with the Department of Labor, and that's a penalty of 15% of the amount involved, also on an annual basis. So it becomes very expensive very quickly. On the individual level, the way that you're seeing claims there is usually through class actions, though individuals can bring claims. Class actions are in the old days, which wasn't that long ago, you know, usually it was the jumbo plans, you know, $1 billion or more, you know, with a B. But now it's coming down market, and we're seeing employers, we've seen one recently, about 300 million got sued in a class action, various allegations of what they did wrong, primarily with regards to the selection of plan assets. But the way that that's occurring is these plaintiffs' firms have access to your 5500. That's why you may sometimes get solicited just out of the blue by some company trying to give you a free review of your information. And they will talk as if they're familiar with the plan, because they will know who the vendor is. They'll have an idea of the plan size and assets. And that's because the 5500 is public information. So anyway, that is what the class action plaintiffs firms are looking at. And the reason that they're motivated is because in addition to the recovery, ERISA awards attorney fees separately above and beyond that. And so if it takes, you know, $10 million to make the participants whole, and the law firm can show that, you know, they have $3 million worth of time and expense involved in this, well, then the ultimate award from a court, you know, could be 13 million, the 10 million to put the participants back in place, another 3 million for attorney fees. And that's what's motivating on the class actions. I would still say, you know, for those of you on the call that have smaller plans, you know, 10 million, 20 million, you're probably still under the radar when it comes to class actions. But that doesn't mean you're not an incentive, you know, to have good practices as a fiduciary, but just have to worry a little bit less with regards to the fact that you're going to get sued in a class action. You're just not big enough for those firms to come after you yet. Okay, let's see. How are we doing for time? We're up on the hour here, Adam. I'm going to whiz through these things, and then we'll let folks get back to um, business as usual. So, as I mentioned, here are the items that I think, if I'm in your shoes, things I'll think about to improve my role as a fiduciary. Documenting those processes important. Remember, assemble information, analyze it, decide, take action. If you have committees that are serving for the plan, I think it's important for that committee to have a charter. That's something in writing that defines what exactly, who's on the committee, what their obligations are, who appoints them, how they get off the committee, and more importantly, whether or not those folks are actually a fiduciary, or if they're just providing advice to the entity and then the entity making the final decision. So document, especially for you larger plans, important to document that process. Next on the list is delegate. If you have the ability, especially on larger plans, usually the incremental cost to participants is relatively minor, and you can farm out services like 316, taking care of notices, disclosures, benefit determination. All of that responsibility can be offloaded, and that's all legitimate. And if you select good vendors, you're going to offload that responsibility with no cost to the employer, provided that you have reasonable costs to the participants. And the same thing with regards to the investment lineup. You can hire outside advisors or investment managers to take care of that. And if you're an individual, consider hiring the directed trustee. Also, pretty minimal cost, and you are unloading a lot of responsibility. Avoid problem assets. We've talked about that. That's self-explanatory. Next two bullet points I think are important takeaways, and then I'm going to let you go. Look at your office package. All of you have coverage. Usually if you visit with your insurance broker, they will tell you whether or not you have fiduciary insurance coverage. And if you don't have it, how much more it'll cost you to have a rider and to have that coverage in place. Usually that's not all that expensive. And I think that is, check that box. If you don't know if you have it right now, when we're done here, go out and make sure you have it in place. And then finally, important to understand, who your vendors are, because there's a lot of people with different hats. And so most of you probably have a TPA, a third-party administrator. That normally is not a fiduciary. They are functioning in a ministerial capacity. They're taking care of things like the plan document or helping people with loans or hardship distributions, explaining plan document to your HR or people that need to know, how various things work. And also on an annual basis, doing your compliance testing and, helping or completing the 5500 for your review and signature. That's the TPA role. Then you have a record keeper. The record keeper is going to maintain the records for the individuals from a tax perspective, and also keeping track of where the money comes from. That's called sources. So every plan has to track, for example, how much came in the way of employee deferrals, how much came in the way of employee match, how those grew over time, what there might be for rollovers. All that is the record keeper's job. Also to track vesting, and then the record keeper is going to produce the quarterly statements that are provided to the participant. Then you have the custodian. The custodian does the trading for you. That is where, when people are pushing the button and buying a mutual fund or selling a mutual fund, or you submit a payroll file and the cash, by payroll, everybody's deferrals are going in and being invested. Normally that's the custodian taking care of that for you. That can be a different hat than the record keeper, than the TPA. And then finally you got the advisor, and then you got the trustee. Each of these in theory could have separate contracts with you. And in every situation, you need these four considerations. Understand their cybersecurity policy. Make sure they have a business continuity plan. So that means what happens if the tornado hits the place, or the flood wipes out the place, or where does your information reside? How will business continue? How will filing still be done in a timely fashion? They need a business continuity plan that should be standard in your vendors. And then the last two things, look at their financial status. You need to be assured that they are big enough that they can stand behind problems that they might cause in the future. So you need to understand their financial status and their insurance arrangements. Those are important, so that in the event that there are problems in the future, who's going to take care of what type of problem. So with that, Adam, I think, let's see, we're a couple of minutes over, but I'm going to give it back to you for any closing comments.
That sounds good. Hey, John, we did have one question here that came up that I think might be better to answer live. So
Okay.
Do we have any recommendations on the appropriate levels of cyber insurance? It seems as if our providers want to keep that close to their vest and state that we only provide what is in our contract with you. So any recommendations on appropriate levels of cyber insurance, excuse me.
So we could actually do an entire seminar on cybersecurity. So it's a little bit dangerous at the end here to open this, but what folks I think need to understand is who's responsible for cybersecurity, and this is a joint effort, right? So for example, Alaris as record keeper, I have the greatest confidence that some bad guy can't hack into our system and steal, and that if that happens, we'll stand behind that. That's in our court. But there are other issues that arise that we can only do so much to prevent bad things from happening. So primarily, when you end up with identity theft, if that end user, has poor cybersecurity hygiene, for example, and they get phished, and or their email gets hacked, or their phone gets stolen, or all the bad things that can happen, my multi-factor authentication only goes so far. It will ping the guy, and we will do everything we normally do, but there's still the possibility that in some circumstances that end user could have their identity stolen and then end up having a loss. And that I think is important for employers to understand, because lots of times, even with the largest of vendors, when the employer is signing off on the distribution form or clicking, that the distribution is acceptable, oftentimes the employer is also authenticating. And that means that the vendor is not responsible to determine whether or not it's really John Doe, or whether it's some bad guy from Russia or someplace, that stole John Doe's identity. The employer is saying, no, that's John Doe, and give it to him. So, various vendors will deal with this in different ways. Alaris, we institute the use of medallion stamps for certain dollar amounts. A lot of the security policies, we do have to play close to the vest, because if I share all of it, then there's that risk that the general public finds out what the roadmap is, analyzes it, finds the weakness, and then exploits the weakness. So that's why oftentimes on the policy itself, they kind of play close to the vest. With regards to the insurance amount, that I think vendors should easily disclose, but that's really only part of the problem. Just because you have insurance doesn't mean that the company's going to pay, or that the vendor's responsible, right? That's the very last thing that comes into play is insurance. The fact that they have cybersecurity insurance does not mean that all of your cybersecurity problems are solved. It's part of the analysis, but it's not, that's not what you should be going for. It's more these, really understanding these other areas. I put on there a site for the Department of Labor. They have a laundry list of 12 best practices or things that you should be asking your vendor about. That's a good starting point. Take a look at that. That will tell you, you probably won't sleep tonight after you read it, but that will tell you, all the things that you have to worry about. And I'm confident that, Alaris covers those. But keep in mind, all your vendors have to check those boxes. If they don't, then you may have some weaknesses. So there, long answer.
Well, that concludes our presentation. So John and I both have our contact information at the end of these slides. So, if you guys think of any questions after the fact here, feel free to email us and we'll get back to you. But John, thank you very much. It was great to get your insight on these topics, and thank you to Alaris for joining. You guys do great work, and appreciate it very much.
You're welcome, and thanks for being agile and covering me on the front end here. But as they say, all's well that ends well. With that, thank you, folks.
Right. Thank you, guys. Bye.
Bye.